the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're listening to Money FM 89.3, and it's now time for Market View, where we take a look at how the Singapore stock market closed for the day, the biggest movers, sectors, and companies to watch to help you better position your portfolios. I'm Alexandra Parada. The SCI closed down at 0.06% at 3,933 points. On the local front, OCBC announced a conditional exit offer to take Great Eastern Holdings private, a move that's been endorsed by GEH's independent directors. The deal is valued at over 1.4 billion Sing dollars and could reshape the insurance landscape if approved at the upcoming EGM. In the global arena, investor sentiment is mixed following Apple's Worldwide Developers Conference, where AI announcements were seen as incremental rather than groundbreaking. Meanwhile, Warner Bros. Discovery is under pressure after a credit downgrade pushed its bonds deeper into junk territory. And trade talks have also resumed between the U.S. and China in London, with rare earths and advanced tech exports taking center stage. And while both sides struck a more conciliatory tone, market watchers remain cautious about whether this marks real progress or simply another pause in tensions. Now, for more market moves and views, joining us today is Too Jun Cheong, Dealing Manager at Moomoo Singapore. Hi, Jun Cheong. Welcome to the show.
Hi, Alexandra. Thanks for having me.
Thank you so much for joining me. Okay, Jun Cheong, the SCI opened at 3,935 this morning. What do you think drove market sentiment, and are there any major movers being led by specific sectors?
So after 5 days of closing the green, the SCI did close slightly in the red today at the 39.33 mark, or 0.06% down. Despite this, say that the SCI has still been trading range-bound at the 38.80 mark to the 39.50 mark in the short-term trading session. This would serve as good news to income investors that prefers price stability, while value and growth investors would have seen a pause in price movement over the past month compared to last year. Sectorial-wise, I think today we saw that a trio of three local banks, they closed in the red today, with DBS declining nearly 1% during the trading day. So despite this, the SCI only fell about 0.06% for the day because there's more winners than losers in the SCI today. So overall, S-REIT did perform better than the banks today because we did see that the US 10-year U has fallen a little bit, indicating a lower interest rate expense for them.
Now, OCBC's conditional exit offer for Great Eastern Holdings has just been endorsed by GEH's independent directors. What are the market implications of this potential delisting for both OCBC and GEH shareholders?
So for OCBC itself, the first and most important thing for the group is that it will have the full ownership of Great Eastern, achieving one of their strategic goals to integrate both banking and insurance fully into their business. This would really allow the group to fully synergize operations across their banking and insurance lines, enabling a lot of their wealth managers to effectively, I would say, cross-sell GE products. So for existing GE shareholders, the implication I do see for them is that it gives them the opportunity to exit at about 70.8% higher than last year's offer price. So GE share has halted trading since July last year, and potentially these are funds, and these are also opportunity costs for all of these existing shareholders. So to resolve the share trading suspension, GE has proposed the delisting of the company. However, if this cannot be achieved, GE would have to seek shareholders' approval on a second proposal to restore its free float by the way of a one-for-one bonus issue comprising of new listed shares with voting rights and with new non-listed shares without voting rights.
But EY assessed this offer as fair and reasonable. So how might this influence investor sentiment and even trading behavior in the lead-up to the EGM, which is scheduled on July 8th?
So for the EGM next month itself, I think this time the offer price of 17.8%, which is higher than the previous offer price, will certainly be, I would say, attractive to the existing shareholders of GE. So, of course, OCBC shareholders, those who are holding it, they are less likely to be impacted by this decision itself. And if any, it could prop up some interest for the group as a whole, as this has been an ongoing decision by OCBC since 2004. So, of course, the whole acquisition, about 900 million, is also likely to be funded from existing resources. Additional capital would likely not be needed, reducing some of the shareholders' anxiety over the group finances. However, one of the things that some shareholders, especially GE shareholders, may not be too happy about is that those who have previously picked up the offer would not be kind of pre-compensated with the 17.8% higher price.
Now, Apple's WWDC this week revealed only incremental generative AI updates alongside a rebranding of its OS ecosystem. How do you interpret the market's lukewarm response to Apple's announcements?
So the market has always reacted best to such announcements, as we have seen from Apple share price last night. It closed about around 1.21% lower on the trading session. And during the conference itself, actually, the share price fell over from the top to the bottom about 2%. So the market has perceived that they have been playing catch-up in this AI space compared to leaders like your OpenAI, Google, Microsoft. And much of Apple's, or we call it Apple Intelligence, the AI features, they are not considered revolutionary because it mimics what a lot of their competitors have shown maybe a year ago, a year and a half ago. So the market is looking at Apple's AI features as more defensive rather than disruptive. Next, there was during the WWDC conference itself, there was also a lack of new AI-centric devices or even hardware that is focusing on AI, which a lot of market analysts or enthusiasts, they were dubbing it as maybe the new AI iPhone or AI MacBook or maybe even the Vision Pro headset.
But given Apple's cautious AI rollout and even the stock's 17% year-to-date drop, do you see this as a buying opportunity or a red flag? And how might Apple's stance on AI affect broader tech investor sentiment, especially compared to its competitors?
Personally, I wouldn't see this as a red flag for Apple. However, it is certainly a sign for Apple and its team to pick up on this whole AI trend. The broader tech investor sentiment on AI is currently still very bullish despite the ongoing macroeconomic and geopolitical issues that we have. And it's really for Apple to pick up its slack and continue catching up on this AI game. So one of the key differences for AI compared to a lot of its competitors is, I would personally say, is hardware. So Apple products such as your iPhone, your MacBook are one of the strategic tools that they can use to utilize and pick up pace on this whole AI race. Apple also do have a good pricing power over their products, and investors who do believe that they can pick up pace in this entire AI race would certainly see this as a great buying opportunity of the Apple share.
Now, moving over to Warner Bros. Discovery, their bonds were downgraded deeper into junk territory after its split-up plan. How should investors interpret this restructuring? Is it desperation or a bold turnaround strategy?
So for Warner Bros., it's clear that they are under kind of a financial pressure, and the junk downgrade certainly isn't one that investors can overlook. On the bright side, however, the management team at Warner Bros., they look to be setting the stage for a clear and distinctive investment plan for the company moving forward. So firstly, they have their legacy business of Warner Bros., which is the linear TV arm, which is still generating significant cash flows due to its long-term affiliate contract. And at the same time, it is also light on capital investment. So the strategic rationale to spin off this will allow this linear unit to operate independently with a focus on price extraction and deleveraging its business operations. Next is really for Warner Bros. And their growth engine, which is the streaming and studio unit. This will require capital, of course, for your originals, your international expansions, and to compete with a lot of its main competitors in this space. So separating this business from the linear side actually gives this unit the freedom to pursue growth, raise capital without being dragged down by the legacy side of Warner Bros. Business. We have seen this model works from the like of its competitors such as your Netflix, such as your Disney. And this strategic move by the management could be one where it can bring the company forward.
But with its $35.5 billion in outstanding bonds, what kind of risk premium should investors demand going forward?
So bond investors, they always look at the 10-year Treasury yield as the base. And as of this month, it's hovering between the 4.3 to 4.4% figure. So the typical credit spread for a BB plus rated debt trades at around 250 to 350 basis points. And with such figures in mind, investors looking to invest into future Warner Bros. Bonds will be looking at high 7% or even 8% yield on Warner Bros. Future bonds issuance, especially if we couple it with the fact that there's some changes to this business itself.
Now, looking at transport, Grab also announced a $1.25 billion convertible bond sale, even as talks to acquire GoTo appear stalled. So what does this sudden return to debt markets reveal about investor confidence in Grab's cash flow trajectory and even path to profitability?
For Grab, this $1.2 billion convertible bond still looks more like a confident capital structure play by the management team. So Grab is leveraging on their improved performance and market sentiment to build more financial firepower for strategic moves, such as the GoTo acquisition, which is currently stalled. This will allow Grab to raise capital at a lower interest rate cost than traditional debt, which is the key characteristics of the equity conversion feature in such convertible bond. This will reduce strains on the balance and show investors that Grab as a company is being opportunistic, especially at the times when their cash flow negative are not at dangerous levels. So, of course, the funds that they receive will also provide Grab with a lot of flexibility. The capital can be used for, of course, the stock GoTo acquisition, future acquisition, tech investments, be it in infrastructure or enhancing AI tools, or even perhaps maybe regional expansion. So the funds from these investors are sort of like a liquidity war chest. It allows Grab to have these funds not to be used immediately, but be used on strategic purposes.
Now, looking at the global stage now, trade talks between the U.S. and China have taken the center stage again because it resumed in London with a strong focus on rare earth elements and even technology export controls. And even after a lengthy session on Monday, it even extended into a second day. And negotiators are exploring potential easing of U.S. restrictions on certain tech exports in exchange for China increasing rare earth shipments, which are critical to many high-tech and even defense industries. Now, with the U.S. reportedly willing to lift some export curbs while maintaining restrictions on high-end AI chips, how might this selective easing shape the semiconductor market? Could investors in such industries expect a breakthrough, or should they remain cautious?
So the talks by both U.S. and China would certainly have huge implications on the supply chains logistics of many firms involved. Should the talks go through and China increase the rare earth exports, this will relieve a lot of cost pressures and for the U.S. and industries that rely heavily on these rare earths. So not just your semiconductor sectors, but also sectors such as EVs, or aerospace, or even defense. There are also, of course, various demands by the Chinese during the talks. However, on the semiconductor side, China wants the U.S. to, of course, ease the restriction on access to a lot of these advanced technologies, including microchips. It is likely that the U.S. will ease trading restrictions on the mid-tier semiconductor chips instead. However, the high-end AI chips will likely not be in consideration due to, let's say, national security or technological supremacy. So, of course, this includes your AI chips from NVIDIA or AMD, which the U.S. views as dual-use technologies. So dual use as in it's both for civilian, commercial, as well as military intelligence application. So as such, this AI chips leader will likely continue to face a lot of barriers on revenues in China unless negotiations are able to remove all of these barriers.
But given the past cycles of tension and truce, do you see this round of trade talks as a genuine turning point or just temporary relief?
For me, I think the trade talks over the weekend certainly looks like a temporary relief on both sides, as there is so far no fixed decision or turning point ultimately being decided. Structurally, on both sides, both the U.S. will continue to retain their AI chip leadership while protecting their national security. And for China itself, they will gain access to possibly mid-tier technologies or chips in return for critical rare earth exports. So despite this, there is definitely short-term stability in the supply chain for rare earth exports and also for China, so they're in need for possibly a lot of these mid-tier technologies and chips from U.S. So with escalating conflicts worldwide and ensuing macroeconomic issues, investors should continue to closely monitor their portfolios, and investors may also consider to look to hedge against such volatilities in the market. Because as market moves, investors should also consider their personal risk tolerance level and adjust their expectations and holdings accordingly.
Well, thank you so much for joining me today, Jun Cheong.
Thank you so much for having me as well.
That was Too Jun Cheong, Dealing Manager at Moomoo Singapore. This has been Market View on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.
To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.